bullish or bearish? This is one of the most common questions traders ask. But the truth is, no one can answer that question for you. Why? Because bullish or bearish is always relative. Price might be bullish on one time frame, but bearish on another. Without knowing which time frame you are trading, the question doesn't really make sense. Instead of asking whether the market is bullish or bearish, I want to give you a simple rule that can improve your trading. Follow the order flow. So what does that mean? The core idea is very simple. Look at whether the most recent bullish candle closes above a bearish candle, or whether the most recent bearish candle closes below a bullish candle. That tells you the direction of the current order flow. Let me show you an example. Here we have the dollar index on the 12-month time frame. You might be thinking, why should I look at a yearly time frame if I trade on lower time frames? Good question. Everything in trading is relative to your trading time frame. If you trade the 1-hour chart and typically enter and exit within a day, you probably don't need to analyze the yearly chart. Instead, you only need to look a few time frames higher. For example, if you trade the 1-hour chart, you might reference the 4-hour, daily, or weekly charts. For me personally, my main bias comes from the daily time frame. Now let's look at the most recent break. You can see that a bearish candle closed below a previous bullish candle. That tells us the 12-month order flow is bearish. So we mark two important levels. The break level, which could act as a potential entry. The top of the bearish candle, which could act as a stop level. Now let's apply the same rule to other time frames. This is the 6-month time frame. The bias is still bearish, and the key levels remain the same as the 12-month chart. Now we move to the 3-month time frame. The bias is also bearish, but now the order flow reference points have changed. We mark two new levels, shown here in orange. Next is the monthly time frame. Here, the bias becomes bullish, with the levels marked in yellow. One thing worth mentioning. We did not mark the most recent candles shown in blue. Instead, we marked the major order flow candles in yellow. Why? Because the most recent break actually happened inside the major order flow candle. So the blue candles represent what we call minor order flow, while the yellow candles represent the major order flow. Now let's look at the weekly time frame. The weekly bias is bullish, marked here in green. And finally, the daily time frame. Even without marking any levels, you can clearly see that order flow is bullish. So now we have the big picture. 12-month, 6-month, and 3-month timeframes bearish bias. Monthly, weekly, and daily timeframes bullish bias. One important thing about this concept. We completely ignore the left side of the chart. There is only one variable in this system. The most recent order flow break. If you start analyzing the left side of the chart, you introduce more variables, which often creates confusion. In my experience, many traders struggle because they try to analyze too much information from the past. If you remove that from your system, trading becomes much simpler.